You are listening to the REI Mastermind Podcast. Join JD as he chats with industry-leading real estate experts and professionals. We learn from their experience and uncover the strategies to their success that we can implement into our own businesses, and we can drive immediate results today. They share their experience and wisdom as we build a foundation to our own success. This is the REI Mastermind Network.
Well, we have Stephanie Walter with Erbe Wealth on the call, and we're going to be talking about wealth creation and how to save for your future, for the future generations here. I mean, this is going to be a great conversation. But before we kick things off, I want to send everybody over to your website and anywhere else you'd like to, Stephanie. The way you spell this now is it's pronounced Erbe, but it's spelled ERBEWEATLTH.com. I'll make sure to have those links in the show notes. But is there any place else that you'd like to send people, Stephanie?
Nope, that's the best way to reach me. That's pretty much where all my content is.
So I know you have quite a bit of background, not only in retirement accounts and a few other things, but real estate investing. But with all of that being said, how did you find your way to this type of work?
Well, I think I started like a lot of people in the W-2, corporate space, and kind of realized after a few years that that really wasn't for me. I was tired of working for people that, thought giving a 2% raise was adequate, and kind of wanted to stretch my legs a little bit. So I started an insurance agency about 16 years ago. And around that same time, I started investing in single family homes. I, never really had any formal training. I've always loved real estate. It always made sense to me. So I just, was investing in areas where I thought there would be growth over time. And luckily enough, I was correct with some of those assumptions. But then in about 2016, I got an invitation to go to like a half a day boot camp, I guess, where they talked about investing in apartments. I really didn't know much about it at all. Got there and was listening to them explain what a syndication was. And the clouds opened up, the sun came through, and I felt like, this is it. I just loved the idea of a syndication, which is a group, basically a group of people are purchasing, a piece of property that's bigger than anyone could do on their own. And I loved the concept of it. And so I did my first syndication in 2018. And realized from that I just never, ever wanted to do one of these by myself again. Just too many moving parts and all that good stuff. And then met through, a group of, people that were doing the same things. My partner, who really loves to kind of find the deal and has the connections to do so. And from there, I started working with investors and pulling money into the deals. And from that experience, I've learned so much from these wealthy investors that made me kind of rethink what I had been doing with my money. And so I transitioned a lot of my money into ways in which I was watching the wealthy do with their money. And as such, I was able to retire from my insurance agency in July of this year and kind of do the capital raising, on an as needed basis, I guess.
Yeah, it's interesting. You just kind of brought it up. And one of the things that stood out regarding some of the background information that was sent over was that you help professionals unlearn what they know about money. What are some of those things that people need to unlearn?
Well, I think the biggest thing that is sort of mindset, but probably the first thing that comes to mind with the wealthy is they view money, they use it. As far and versus all of the regular people who use their money to accumulate. And the difference is if we picture a 401k where money is just being set aside for some future date, really don't have much control over it, the fees, all of those things. What I found interesting with the wealthy people is they simply largely don't have 401ks. They're constantly using their money, and they're using it, sometimes in several places at the same time. But the 401k, I did notice that they just were not, when I would go through people's financial statements, very few of them had 401ks, and it took a while for me to kind of place it all together. But essentially that is it, is they look to use their money and not have it tied up to where they can't be knowing exactly how much they're making at any time, as well as knowing any kind of tax issues, mitigating tax issues, which I think the 401k, besides the fees and the lack of liquidity, is nobody really knows how much money they have at the end of the day, because we don't know what those future tax rates are going to be.
Right. It's kind of interesting. We've kind of been programmed to just set it and forget it when it comes to our retirement account.
Mm-hmm. Yeah. And when you start looking at them a lot closer, there's a great deal of fees that you get charged. And I guess if you want to go the route of why we're doing this, is a lot of the financial people, the financial powers that be, probably really love that we just stick the money in, set it and forget it, because then we don't have access to make decisions with our own money. And I believe that you can make many better decisions than what that 401k can do for you over time. Sure.
So you brought up, one of those options is syndications and getting involved there. But, I think this goes back to something that my audience has heard me bring up a number of times. Whatever you focus on is what grows. And when you put your money in a 401k or a retirement account, frankly, you're pretty much kind of a wish and a prayer when you send it. You're just hoping that it's going to work out when you need it in the end, versus actually making some of those active decisions and providing a little focus and a little energy towards that retirement account. It's probably going to be your best investment you make when it comes to that retirement account.
Correct. Yeah. I think it's just another thing that the wealthy do that's different is they invest in people, in ideas, in businesses. And many people think that they're investing in businesses with their 401ks, but you don't know who's running any of those individual companies. Largely, if you asked anyone, what it is that is their plan going forward. Just any of those questions are things that the average investor would not be able to answer. Whereas a syndication or a real estate purchase, you're going to understand the team that's running the deal. You're going to understand what their philosophy is and what kind of strategy they have to make this investment. Really, a syndication is just it really is just a business. It is a piece of real estate, but it's being run like a business. And those are the things that you see the wealthy doing over and over again. Another thing that they look at differently, I think, than most people is that they're very concerned with cash flow. And that's another area where the 401k kind of lacks, in that you're not getting any cash flow. If you asked a wealthy person whether they think cash flow is more important or net worth, they're going to say cash flow all day long. I'm a pretty good example of that, is I had invested in a lot of single family homes, had a great deal of net worth on paper, but had very little cash flow, and probably wouldn't have had the cash flow to retire until those properties had been paid off probably 20 years in the future. And so cash flow is things something that most people don't think about as an investment, but by having cash flow, it gives you a lot more freedom to, somewhat retire or change careers and do something that you really enjoy doing.
Well, can you talk a little bit about how your syndications then can help regarding cash flow? Is that a piece of it?
Yeah. So, real estate syndications, they're structured where, we purchase a property, we do a great deal of vetting to get those properties under contract. In fact, we are so, strict with what we require out of these properties that we probably only close 2 a year. And from those, from closing, we stabilize the property, which takes, probably around 3 to 4 months. And then after that, every month, the investor is sent a check or an ACH to their account of between 7 and 8% of their investment. And that's paid to them all the way through the investment. We invest mostly in multifamily properties that have that cash flow. But at the end, we hold the money is in the project for 3 years. Roughly, that's and then when we cash out of it, we have lots of different properties, but we always look to give our investors at least a 20% return, annualized return on their money.
So that's year over year, or is that for the total of the 3 years that they have invested?
That's annualized year over year.
Sure. Okay. Well, that sounds really interesting. Can you give us an example? Like, what project are you working on right now? What are you trying to take down?
Well, we have one. It's in Cape Summit or Cape Coral, Florida. It's called Cape Summit. And this one's an interesting one because it's not like your typical cookie cutter one that we come across. This one, actually, we were able to purchase off market from the developer who basically had made his money and didn't want to, mess around with waiting for certificates of occupancy or anything like that, just wanted to close and move on to his next deal. So we are acquiring this property at the end of September is when this one will probably be closing, and we'll get the certificates of occupancy at closing. And we've marketed this property to be fully occupied when we close. And so we were able to buy this one at a discount, a significant discount. And so we're looking to, on this property, return a 23% return to our investors. And we're planning to hold it for 3 years.
Mm-hmm. You're the first person that has come on as a syndicator who's so free with what you expect, percentage wise, when it comes to the returns.
Well, that, I don't know, there could be a couple reasons for that. One, we're on our 7th deal, my partner and I together right now. And we started out doing 506Bs, which means that you can work with unaccredited investors, but you have to be you can't broadcast what you're expecting to make for your investors. So what we do is we do all of our investments as 506Cs, which means we work with accredited investors only. That just means that you can either qualify based on your income or you qualify based on your net worth. But essentially, when it is a 506C, you can broadcast, your returns. And for us, it's our 7th deal, and every single deal we've done has given our investors returns over 20%. And that's sort of our goal, going forward is we want to have over 20% returns.
Sure. No, it's just kind of refreshing. So, we should clarify that. Can you talk to what it takes to become that accredited investor? I know you talk about the income and your net worth, but what are those type of details?
Yeah. So to be an accredited investor, it just means that if you're single, you have an income of $200,000. If you're married, you have an income of $300,000. If you don't qualify that way, if you have a net worth which excludes your primary residence of $1 million. There's actually another one that people don't talk about a lot. But if you have certain financial series, like your Series 6 or 63, you can qualify without actually being accredited.
Sure. So like, when you get accredited, it sounds like some sort of diploma. Do you have to go through some accreditation process?
No. But if you do, participate in one of our deals, we ask, are you accredited this way or that way? If you're accredited by, and then you just send over kind of your proof that you're accredited, and
Sure.
it's pretty easy.
So you mentioned, once you get these properties, you get them stabilized. What are the things that you typically have found that you have to do in order to stabilize these properties?
I think it's more for us is just getting our kind of arms around what we're working with. Like when I was talking about this Cape Summit property, there really isn't much to get our arms around other than, getting it up to full occupancy. But we have taken over ones that are possibly need renovations, things like that. So it usually takes us a couple months to kind of see, we want to keep our vacancies very low. We want to be sure that, there aren't any out-of-pocket expenses that might come our way that we're not prepared for. So for us, it's more like that we're putting a little money aside in case like a surprise comes up. With the Cape Summit property, it's brand new. So I mean, literally brand new. So I don't expect that we have any money to put into that. So it's more for us to, just get our feet on the ground and be sure we're fully understanding everything before, and have a little extra money into the bank before we start distributing the returns to our clients.
Yeah. So, you talk about, it sounds like you're buying these properties throughout all over the country, or are you focused on certain areas?
Yeah. Well, when we first started, I did my first one in Colorado. That's where I'm from. And then we had another one we did in Texas that was brought to us off market. But largely for my partner and I, we do everything in Florida. And so we do it in Florida because my partner has 35 years of being a commercial broker in Florida. And so he just really has the connections, which I honestly believe you really need to give your investors a good return, because things that just come on the market, if you're probably not going to get that great of a deal. And our philosophy is we really want to make the money for our investors on the buy. We don't want to buy and then hope that we'll be able to, increase the value. We really want to, make the deal on our buy. And in order to do that, you really have to have some solid relationships with people that can bring you off market deals. And even with that, we look at, hundreds of deals before we find one that'll make sense.
Yeah, I was going to that does lead me into my next question. You mentioned you tackle about 2 opportunities a year. How many deals do you actually have to look at in order to find those 2 that meet the mustard?
Yeah,
but before you answer that, I want to remind everybody to head over to your website, erbewealth.com, and I'm going to make sure to have that links in the show notes. But I think you're pretty active on LinkedIn as well. Is that a good place to find you?
I have LinkedIn. I have a profile on LinkedIn as well. I'm trying to get a little bit more active on there.
That's a great place to connect with people these days.
It is, definitely. But yeah, no, hundreds of deals, literally. Like we have a whole group of people that just do the underwriting, on deals and, just go through what we're looking for. And then maybe we do find something that may work, but then you look a little bit closer and they're just, commercial real estate is one of those things where there can be, you just kind of have to be a detective. It's not like residential real estate where they have to disclose everything to you. Mm-hmm. Commercial real estate is a little more sneaky. So you have to be sure that you do your complete due diligence. So there might be 4 properties we put under contract, but then maybe we exit out of a couple properties once we've gone in and done our due diligence. So it really is a long process. So I hear some people are like, well, why don't I just create my own syndication? It's for that very reason, because it really takes a long time and very specific knowledge to find a deal that's going to make sense.
Well, there's always some low-hanging fruit there, though. Is there specific things that you check off the box, like right off, you determine whether it's a good fit or not?
Yeah, I mean, for us, I think we want it to be in Florida because we have lots of boots on the ground there. We've been able to kind of acquire a few markets in Florida where now they know us a little bit and what we've been able to do. So we're approached a lot more with different investment opportunities. But yeah, we're largely looking in Florida.
Sure. Well, this is always such an interesting topic. What was, let me back up on something there. You mentioned earlier that you work with accredited investors now, and you kind of made that transition. What caused that big transition to move to accredited investors?
Well, I mean, I think at the end of the day, when you work with the non-accredited investors, they're just probably not quite as savvy as to how, things work. And also, there's just a lot more reporting that's required in a 506B than a 506C. A 506C, we get syndication attorneys, so attorneys that are SEC. We're all, we have to follow all of everything that we do. And I just, that for us, that's where most, investments are put into the 506C category.
Sure. Now that you've been doing this for a few years under this syndication, how many doors are you currently managing and own?
We have about 300. So we haven't but it's about, I think after we close on this one, it'll be a little over $50 million. So I really like how my partner and I kind of wanted to grow kind of very organically in this business. You see a lot of people that jump into 200 or 300 units, for one of their first deals. But for us, it was just really important for us to just grow at a natural pace. And so for us, that meant we started around 20 to 50 units, and then 50 to about 70. And now we recently got one under contract. We're still in the very early stages of it, but that's 160 units. Mm-hmm. But for us, it's just really, both of us are very, very concerned about doing what we say we're going to do. I think it probably comes from our backgrounds. I was in insurance, so you have clients you want to be accountable to. And then my partner was in a commercial broker. So our clients are everything, our investors are everything to us. And we want to, do what we say we're going to do. We've seen a lot of people that jump into these bigger deals and they just, they don't know what they're doing, and they go a bit sideways. You talk to certain investors who were expecting to get regular distributions and haven't gotten a distribution in a year or two. And for us, that was just, we never wanted to get huge. We just wanted to do the right things and felt that would lead us into, getting bigger over time, which seems to be what's happening. So that's a good thing.
Yeah, well, it really allows you to take a moment and flush out your processes and stuff too, to fill those gaps. And when you're ready to take on those bigger deals, I mean, it helps with the scaling.
Correct. And also, I think both of us, it was important that we know we like each other. We know we work well together. And when you get into some of these larger deals, you have to bring a lot more people in. You might even have to bring in family office money to help you close on the deals. So there's just a lot more cooks in the kitchen, I guess. And for us, we like our systems, and we like creating, I guess it's like a small business, and we're creating these systems as we go. And we like, having our accredited investors invest in, not taking these great big family office contributions, because they tend to want to run the deal, and we feel we're best at doing that. And that's sort of what's led us to grow, slowly and steady.
Sure. I have to go back a little bit here. You've been in the insurance game for 16 years. There had to have been a pretty significant mindset shift to make you motivated to make that type of change. What exactly happened there to make you decide to take the jump?
Well, I think over time, what I loved about insurance was the clients, obviously, but what I didn't love is having this big corporation kind of do things that maybe I didn't always agree with. Mm-hmm. And as time went on, those things were more pronounced, I guess. And so what I loved about real estate and doing things this way was that these were my deals. This was how we saw things going, and we were making our investors happy at the end of the day. There wasn't going to be some big corporate person come in and say, well, we've decided to cut 20% off of their returns, or we've decided to, come up with this fee now, and we're going to be taking, $100 of your investors' money away. So for me, that's I felt like I felt very free leaving the insurance. I'd always been an independent. I worked for Farmers Insurance, but they consider us independent contractors, but yet all the rules came from the big corporation. And so it was really attractive to actually create your vision of what you want to create for your investors, and then not have someone come in and alter that.
So did you sit down and essentially make a pros and cons list and decided to make the change? I kind of probably in my head, but I think once I learned about a syndication and how that worked for me, I was sold on the proposition. So it was just a matter for me of getting my income, my passive income, to replace my business income. And once I'd done that, I was ready to give them my notice. Sure. So when you decided to do this, how long did it take you to get your first property under the syndication? How long did it take you to get that first one under contract and then eventually close?
I started in 2016. So you kind of do like a deep dive at that time, because it's not like single families. I joined a group called RE Mentor for my education. And that really, I tell people, is like getting a master's in real estate syndication, because there's just so much to learn. And then I did have offers out and, have ones that went under contract, but the first one that closed was in 2018. So it took 2 years before the first one closed. You're doing a lot of education along the way. And then after that, it's just from 2018 to 2021, we'll be on our 8th. I did one by myself, and then I've done 7 with my partner. So I'll be on my 8th syndication this year.
Well, that's awesome. So once again, head over to erbewealth.com, and it's spelled ERBE wealth.com. I'll make sure to have those links in the show notes, but I really appreciate your time. But before I let you go here today, is there a question you wished I would have asked you?
Oh, that's a good one. Goodness. We covered a lot about the wealthy. I think a good question is I think a lot of people think another myth about what the wealthy people think. Or people think about the wealthy investor is that the reason that they got wealthy is because they invested in really high risk opportunities, and that's why they got wealthy. And I think that from working with the wealthy people that I have, that nothing could be further from the truth, that they like to just vet and be very conscious about what they're investing in. And actually these syndications, if you look at them historically, they provide the best return with the lowest amount of risk as almost anything out there. That's why big banks, insurance companies, and pension funds invest in some of these larger syndications, because the money is it's a lower risk opportunity.
Sure. No, that was a great way to end this. That's a great myth to bust. I really appreciate your time. This has been a great conversation. I hope you'll come back again sometime.
Yes.
And I'll make sure to have those links in the show notes. Please reach out, and especially head over to the website, erbewealth.com, because I think there's quite a bit of resources and content there.
Thank you so much. I appreciate you having me.
Well, I appreciate it, and you're welcome back anytime. So it was great chatting with you.
Great to chat with you.
This has been the REI Mastermind Network. You can already tell that we've made some changes, and a few more are on the way. If you are interested in what we have planned, head over to patreon.com/REI Mastermind and support the show today. Financial contributions are always appreciated, along with a like, share, and review. It really helps us grow and reach more people with this valuable information. See you next time, and tell a friend.